Okay, there we go. Forms of business ownership. So we will learn what a sole proprietorship is, how to start one. We'll learn what partnerships are, and different types of corporations. Those are the three most common forms of business ownership here in the US. We'll look at other forms of business ownership as well, like cooperatives, LLCs, and others. And we'll talk about franchising. Now, franchising is not a form of business ownership on its own. What it is, it's a relationship between two businesses. So you've got the franchisor and the franchisee, and they have a franchise relationship. Now, each of those organizations could be a sole proprietorship, a partnership, corporation, or any other type of business ownership. So this is really, again, not a form of business ownership, but a relationship between two businesses. So we'll get to that probably Thursday. And we'll talk about mergers, when two businesses come together and become one business, as well as acquisitions. So who could tell me, how does an acquisition differ from a merger? What does it mean to be an acquisition? One company acquires the other company, so it's a purchase. In a merger, you got two companies just becoming one. But in an acquisition, you have one company buying another company.
Is that like Google buying YouTube?
Yeah, okay. Exactly. YouTube was a separate company. Google bought them. Instagram was a separate company, and Facebook at the time bought them. Now it's Meta, but same idea. Exactly. So it's similar in that you have two companies coming together, but the dynamics are different when it's an acquisition. Because then you have a clear party that has the power over the one that got acquired. In a merger, theoretically, it should be a shared power sort of situation. And we'll talk about trends in business ownership. So this graphic, I think, is pretty interesting because what it says is that here in the United States, the vast majority of businesses are sole proprietorships. Now, what does it mean to be a sole proprietor? If a company is a sole proprietorship, what does that tell you about it? How many?
Single owner.
Single owner, exactly, that's what it means. Sole means single, and proprietor is owner. So there's only one owner. With a partnership, you've got at least two partners. So it's shared ownership. And in a corporation, you could have as few as one owner, but you could have thousands. So it just depends. So sole proprietorships make up the vast majority of the businesses here in the United States. 72%. But if you look at how much sales revenue they only generate 4% of the sales revenue. So even though they're a very common form of business, they don't bring in a lot of money. If you compare that with corporations, they're 18% of the businesses, but they bring in 82% of the sales revenue. That tells you something about corporations. They have the ability to sell more product and services. That's probably why the largest companies tend to be corporations. And then with partnerships, we see they make up 10% of the businesses and bring in 14% of the sales revenue. So why do you think sole proprietorships are so popular if they have such a hard time bringing in sales? Well, they're easy to start. let's talk about what a sole proprietorship is. Let's say you're really good at fixing cars, fixing car engines.
Or
And-
desktops.
Okay, that's a better example. Desktop computers?
Yeah.
Let's go with that. More modern.
I think so.
And your neighbor asks you to fix their computer and they pay you some money for it. And then somebody down the street asks you, and then your aunt asks you. And you find you're busy fixing everybody's computers. And you're making some money doing that. Guess what? You have a sole proprietorship. You started a business. If it's something you do once in a while and you only bring in a little bit of money, you could consider it a hobby. But once you start making a certain amount of money, the IRS expects you to count it as business. And automatically, it's a sole proprietorship. Adriana?
I was gonna say that they might not be at the maturity level yet in their business.
Mm-hmm.
So they might start the business, but since it's a new business, it might be harder for them to get like a certain clientele
Mm-hmm.
or to be able to sell to like retail stores or
Mhm.
wholesalers.
Yeah, exactly. So a lot of businesses just start out small with people that they know. And it's one thing to operate on that level. If you're trying to go to, let's say you're trying to convince GameStop to let you,
Or the
Fix-
gamers in control in Salinas.
okay, well, I'll go with GameStop. If you're trying to convince GameStop, which is a national chain, to let you come in and fix their customers' game systems, they would probably say, no, we only work with, larger established providers, right? So as a sole proprietor, you're kind of limited. But it's very easy to start sole proprietorship from a legal standpoint, because there's really nothing you have to do. When you start making money with your business, you have to pay taxes. So when you file your income tax return, there's actually just one particular form that you include, it's Schedule C with your income taxes, and that's how you declare the profit or loss you made from your sole proprietorship.
Yeah, I just had a question. Do you think it would be easier to start your own business as a sole proprietorship or to invest in a franchise?
Oh, it's definitely easier to start your own. Yeah, and when I get to franchises, you'll see that they take an upfront investment, sometimes in the thousands, sometimes in the hundreds of thousands, depending on the franchise. And you have to play by the franchisor's rules. They have all these requirements, so it's definitely easier just to start your own sole proprietorship. So they're very easy to start. Typically, whatever city you're in will require that you have a business license. You don't have to take a test or anything. You just fill out a form, you pay a small amount of money, and you have a business license. There are rules about where you can operate your business. Certain areas are residential only, and you're not allowed to have customers come into your business. It's a good idea to have business insurance. So I'm not saying that it's easy to start a business, but to make your business a sole proprietorship, there's really nothing special you have to do. It's automatically a sole proprietorship when you start a business. So what are the downsides? As I already mentioned, sole proprietorships typically don't generate as much sales revenue. But why do you think that is? Why is it that they have a hard time attracting a lot of customers compared to corporations, for example? Okay, so advertising and having employees, that's definitely part of it, because it takes money to advertise and it takes some expertise. You might need employees that know what they're doing. That takes some cost.
I was gonna kind of say,
Same thing. Yeah, Jade.
But you probably won't have the support of like a major company so everybody goes in.
Exactly, you don't have, if you have a franchise, then you've got a franchisor that can give you certain expertise and support. But if you're just a sole proprietorship without any kind of franchise arrangement, you don't have that. And so what does it take to do the advertising, to hire the employees? It takes money, right? And where do you get money? If you're a corporation, you can issue stock and have investors give you money. And then you use that money to grow your corporation. If you're a sole proprietorship, nobody's going to invest in you because you're the only owner. They cannot be part owner in a sole proprietorship. There can only be one owner.
I just had a quick question about the corporations
Mhm.
and this, being able to sell shares. Is there like a certain cap that you have to get to before you can actually sell shares? Or is it just, you're given shares at the beginning of making the business?
Well, so this is the way it works. Well, actually, we'll get to it in a minute. So I'll just give you the quick answer is any organization could become a corporation and could sell shares privately. If you want to be able to sell, if you want your stock to be sold over a stock exchange, that's a different story.
Okay.
That
Fair
takes multiple years and lots of money to get there.
Okay.
But privately, it's not that hard. Okay. Okay, so we talked about the main drawbacks. Actually, one other big drawback is since there's only one owner, there really is no separation between the business and the owner. So if you start a business as a sole proprietor and the business has debt, it's your debt. If the business does something illegal, you are liable. If somebody gets injured by the business, you are liable.
That'd be an unsportsmanlike conduct.
Yeah, even if it's an accident, you're still liable. So there's no separation between the business and you. Which means anything you own, well, there are some exceptions, but let's say you've got a bunch of money in the bank and maybe you have an investment property. And the business runs up some debts or loses a lawsuit or something, your personal assets could be at jeopardy because of the business's situation. Because there is no distinction between you and the business. No?
So in a sole proprietorship, the business is not separate entity,
Correct.
but in a corporation, it is a separate.
It is. Right. So let's talk about partnerships and then we'll get to corporations. Now, partnerships are complex to operate and even just to understand. So one thing about partnerships is there's a strong likelihood of disagreement at some point between the partners. You're sharing ownership in a business with somebody else. There probably comes some time when you disagree about things. And then what do? Because you're kind of stuck together. It's kind of like a marriage where, you can try to work it out. Sometimes it doesn't work out. And then you have to dissolve the partnership, which is unfortunate. So there are four main types of partnership, depending on how you want to structure it. There's a general partnership where every partner helps manage the business. On the other hand, there is a limited partnership where you have one or more partners who are helping manage the business, but you have limited partners that all they do is they just put money in, kind of like an investor, but they don't get involved with running the business. So in a limited partnership, you have one or more general partners running the business, one or more limited partners just putting in money and hoping for some profits. And then you've got a couple other varieties here, like a limited liability partnership and limited liability limited partnership. So you can see it gets kind of complex. And it really depends on many different factors. So if you're thinking you want to go the route of a partnership, what you really want to do is consult with an attorney that can help you decide if a partnership makes sense. And they would help write the partnership agreement that all the partners would sign off on. So everybody has in writing an understanding of how it's going to work. Okay, but in general, I would avoid partnerships. As you've seen, they're only 10% of the businesses, and there's a reason for that. They work well if you have a group of professionals, like a group of doctors, a group of accountants, a group of engineers or lawyers that can come together and share an office space, maybe have a shared administrative staff, but they each kind of see their own clients separately. That could work pretty well for a partnership. But if it's just you wanting to start a business and you want to involve some friends or something, or your family members, I would not do a partnership. First of all, it's dangerous to mix your personal relationships and business,
Might
right?
be unsportsmanlike.
It could be, because when disagreements arise, as they inevitably will, not only could that damage your business, it could damage your personal relationships. That's not what you want. So what I would recommend, if you are thinking of starting a business someday, and you do want to involve certain people that you know, there are other ways to accomplish that. You could keep it a sole proprietorship. And those people that you want to work with you, they could be independent contractors or maybe employees. You don't necessarily have to share the business with them. That makes it a little easier if things don't work out. You're in control and you can just say, hey, look, I think it's better if we just go back to being friends and not try to work together. It'd be a lot easier to do that than to dissolve a partnership. Or you could set it up as a corporation. Say, okay, I'm going to retain the majority of the stock myself, so I can outvote all the rest of the people that are investors. And they can own part of the business, but I own the majority. Again, that allows you to retain control. And if things don't work out, you buy back their stock or find some other solution to kind of get out of the relationship without having to dissolve the business. So, does anyone have questions at this point? Yes, Karen.
Would family-owned pizzeria be a partnership, or would that be considered a sole?
So there is such thing as a family partnership. So it could be set up that way. Usually those are done to kind of protect the family's assets. It's possible, or even just a standard partnership. It's possible to set it up that way. But I would say typically most family businesses are sole proprietorships. Just whichever person started it, it's technically their company. And the rest of the family members might be employees, or they might even be working off the books. Because it is a little like if you own a shop, you could have your kids work in the shop and the rules are different compared to if you hired somebody else's kids. So when it's within the family, you have a little bit more flexibility, from what I understand. So I think typically they would be sole proprietorships. Okay, so let's say you decide that partnership is the way you want to go, for whatever reason. You're gonna start a business and you feel you want partners. And you say, I'm not gonna listen to Trav, I'm gonna go ahead and form a partnership. Well, think about why is it you want a partner? Is it because they have certain skills that you don't have? Okay, well, that's fine. But again, they don't have to be a partner. It could be an employee or a supplier or an investor. They don't necessarily have to be a partner. How are you gonna divide the responsibilities? Who's responsible for what? And again, that should be documented in the partnership agreement. What is your long-term vision of the business? And does the other person have the same long-term vision? I can tell you stories about failed partnerships where, you know, two friends went into business together and ended up not friends anymore because they didn't have the same long-term vision. Exactly. And, you know, what's going to be expected of every party. So that is my overview of partnerships. Let's move on to corporations. Now, we've been talking about corporations since day one, right? I told you that in some ways corporations are kind of like a biological entity, like a person, right? Well, let's dig into legally how they operate. In a corporation, the stockholders are the owners, right? Stock in a corporation is ownership. The more shares of stock you own, the higher the percentage of the corporation you own, right? The bigger proportion. Now, those owners that own the stock, they elect a board of directors to represent them. And that board of directors is actually more powerful than the CEO because they can hire and fire the CEO. Like I probably mentioned to you how Steve Jobs got demoted within Apple. He was the CEO, even though he started the company.
Sports icon.
Well, he was actually, I mean, okay. He was very hard to work with, from what they say. But he was very successful at running the company. And he was one of the two founders. But it came to a point where the board saw things differently. They thought the company needed to go in a different direction. And so they demoted him and he said, well, forget that, I'm gonna quit. And then he went off and he started another company that was very successful. And he also started Pixar, the animation company, as well. And Apple ended up buying the software that his other company, I think was called Next, I don't remember. But Apple ended up buying the software that Steve Jobs' other company created. And they ended up bringing him back later as a CEO. But the point is, the board of directors had that power to demote him and later to bring him back. There was a recent similar case with the company OpenAI, where there was a board of directors. Now, their structure was kind of complicated, but still there was a board of directors that got rid of the CEO. And what happened in that case was very interesting because the employees said, if you don't bring that CEO back, we're all going to quit. Well, not all of them, but the majority of them were threatening to quit. And so the CEO actually was allowed to come back even after the board had fired him. And the board was then disbanded. That was very unusual. So it was really the employees that had the most power in that case, right? But it's not that common that you have the majority of employees in an organization threatening to quit all at the same time over one issue. So back to normal corporations. Normal corporations, the investors elect the directors, the board of directors. The board of directors hires and fires the executives, sets the strategic goals for the organization. So it creates this interesting dynamic because it's the executives that are running the business on a day-to-day basis. And generally, they're trying to get the stock price to go up. The more profitable the company is, the higher the stock price tends to be. And that attracts more investors. And also, these executives are rewarded through stock. So when the stock price goes up, they make a lot of money. So you have this dynamic where these executives are trying to bring the stock price up every quarter, trying to always push it higher. And sometimes they try so hard to do that that they're willing to break the law or to be unethical in order to make more profits. In fact, there have been cases, it's rare because white collar crime typically does not get prosecuted very heavily. But there have been cases where executives have gone to jail because they did illegal things as an executive. Now, what's interesting about this dynamic is these investors up here, the ones that elect the board, which oversees the executives, cannot be held liable for the actions of the corporation. So if you buy stock in a corporation and that corporation goes out and does something illegal, you're not responsible. You just bought their stock. And if that corporation has financial difficulty and goes out of business and has a ton of debt, you're not responsible for the corporation's debt. Because again, all you did was you bought the stock as a stockholder. So when you buy stock, the biggest risk for you is that whatever you paid for the stock, you never get that money back. That's the worst that could happen as a stockholder. So we've got these stockholders that are willing to take a risk, but really don't have that much to lose. They can only lose their investment. And they are pressuring the executives to go out and make as much money as possible. And sometimes to the extent that they end up breaking the law, but the investors who would be benefiting from that are not held accountable. They cannot go to jail. They cannot be held responsible for the corporation's debts. And in a sense, that is what makes corporations so powerful and so successful. They can attract all this investment capital from investors, use it to grow, and the investors know, that they're fairly safe. All they could lose is their money. And it gives the corporation this incentive to do whatever it takes to make a profit. And that's why sometimes corporations act unethically. So that's how corporations work and why they can get so big. So this line you see here, limited liability, applies to the stockholders. The only thing they are liable for is whatever they invested. They could lose that money, and that's it. That's the worst that could happen. Any questions or comments on corporations? All right, so I'm going to show you a video now. Again, it's the founder of Chobani Yogurt, Hamdi Ulukaya is his name. And it is a little bit longer. It's about 18 minutes, but it is worth it. Okay, if you decide that you want to incorporate, so you want to set up a business where the business is a separate legal entity. It can hire and fire people. It can own property. It can sue. It can be sued. And that's completely separate from you as a person. So you're not personally liable for the actions of the corporation. If you want to set it up that way, you can do it. Anybody can form a corporation. I mean, as if you have to be at probably 18 years old, and there are some requirements, but pretty much anybody can establish a corporation. How you would do it is you would pick a state, because every state has different laws about incorporation. And if you don't like California's corporate laws, you prefer, let's say, Nevada or Delaware, those are very popular states for incorporating, you can pick one of those states, even if you're not operating in that state. So whatever state you pick, you would apply to be a corporation. You have to pay some fees. you have to file articles of incorporation. And here's what you are going to include in the articles of incorporation. Again, you'd probably want to work with an attorney to help you set this up. But you would specify the name of your corporation, what its goals are, what type of stock you want to be able to sell, and how many shares. You could also issue bonds, but that has to also be approved by the state. Is this corporation only for a specific period of time, or what's more common is it's just going to be perpetual, meaning it's just going to keep going, and even if all the original investors have passed on decades ago, the corporation can still exist. The stock just gets passed to their heirs or to whoever they sold it to. So the corporation basically can live forever. How much does the investor need to pay to buy stock? If you have an investor who wants to sell their stock to somebody else, how does that happen? If the company is publicly traded, that can happen over a stock exchange. But as I mentioned earlier, it's a long process and very expensive to be able to be publicly traded on a stock exchange. So if you're just privately traded between private investors, how can those exchanges happen? What are the rules? Where is the corporate office? This is important because if the corporation is sued, the plaintiff that's making the lawsuit needs to know where to send the subpoena, where to serve the papers to let the corporation know it's being sued. It's also important because what if the IRS wants to come and audit your books? They need to know where you're located. And then who's on the board of directors. So this is some of the information you would include in your articles of incorporation. You probably also have some bylaws that explain how the corporation's gonna be governed. Here's an example, it's kind of an old example of what articles of incorporation could look like, but these days we don't type on typewriters, so it probably wouldn't look exactly like that. But that just hopefully gives you an idea of the process of incorporating. You have to have a board of directors, and that's giving up some power. Even if you're the founder and the chairman of the board, you've got other people on the board too that have some power and some influence. You guys can keep your voice down a little bit. I appreciate it because it's a little distracting. So what we're going to do right now is I'll pause the recording again. Okay, I'll give you 8 minutes to come up with your group questions. All right, and then we'll come back and we'll cover 2 more slides. Cover 2 more slides, the remaining minutes that we have. Let's compare the pros and cons of these 3 basic forms of business ownership. So, sole proprietorships. If you start a sole proprietorship, you don't have to share profits with anybody because you are the owner, right? Whatever profits you get to keep. It's very easy and inexpensive to start from a legal standpoint. You might have equipment and employees that you need. But as far as forming the business, it's very simple and inexpensive. You're independent. You don't have to listen to a board of directors or investors. Those would be the pros of sole proprietorship. The advantages of a partnership, they also have fairly low costs. You do, again, need to develop a partnership agreement, and you probably want to pay an attorney for that. But other than that, it's not very expensive or complicated. If you incorporate, the advantages are you limit your liability. Your personal assets are safe and they cannot be seized because of the actions of the corporation. You can issue stock. You can get investors to give you money that you never have to give back to them. You get to just keep it and use it to grow the business in exchange for giving them part ownership, right? So those would be the advantages of corporations, at least the main advantages. Let's look at disadvantages. With corporations, they have what's called double taxation. Does anybody know where that double taxation comes from? The corporation pays tax on its profits. And then if it gives dividends to the stockholders pay tax on the dividends. So those profits got taxed at the corporate level and then at the investor level. Corporations are more heavily regulated than other forms of business ownership, so that would be another downside. With partnerships, if you want to change partners, you have to dissolve the partnership and then form a new business. So it's very, burdensome to do that. It's possible, but it's kind of a hassle. And I would say the biggest downside is that potential for conflict between the partners, right? And so those would be negatives. For sole proprietorships, the downsides would be unlimited liability. Whatever the business is responsible for, you are personally responsible for, financially and legally. And that's it. So those are the main pros and cons. On Thursday, we'll get into other forms of business ownership and how they compare. So see you all Thursday.
And I'll see you next Tuesday.
That's right. Have a good time in Fresno.
Starbucks.